Welcome to 529 Investment Secrets. In this video, we'll explore why many top investors often choose out-of-state 529 plans, even when that means giving up state income tax deductions. As we get started, we'll also look at how to build smart portfolios inside 529s, how to use target date funds for a hands-off approach, and how fees and diversification drive outcomes. Next, we will outline today's agenda so you know exactly what to expect. Here's our roadmap. First, we'll discuss why your own state's 529 plan might not be the best choice. Next, we'll show you how to get broad U.S. market exposure, even if your plan doesn't list the S&P 500 directly. Then, we'll cover target date funds for a hands-off strategy. After that, we'll compare low fees with modest state tax breaks and look at the long-term math. We'll then walk through a 15-minute selection playbook. Finally, we'll wrap up with 2 quick quizzes and a concise summary. Many investors assume their state's 529 plan is automatically the best because it may offer a tax deduction or credit. However, experienced investors often prefer nationally recognized plans with lower fees and stronger fund menus. Over long horizons, the combination of lower expense ratios, sensible index options, and disciplined asset allocation can outweigh the value of a modest state tax break. With that context in mind, let's visualize a simple decision framework. This flowchart begins with whether your state offers a meaningful tax benefit relative to your planned contributions. If there is no meaningful benefit, the decision often leans toward a top national plan with lower fees and better index choices. If there is a benefit, the next question is whether the in-state plan's fees are materially higher or the fund lineup is weaker. If not, it can make sense to stay in-state and claim the tax break. If the in-state plan is costlier or weaker, consider whether, over your time horizon, the lower fees of an out-of-state plan can outweigh the tax benefit. If yes, choose the top national plan. If no, stay in-state. Finally, it's wise to reevaluate annually or when fees, contributions, or plan menus change. Next, let's quantify why fees matter so much. Fees compound in reverse. Every year they shave a small percentage off your returns. Over a decade or more, a lower expense ratio can produce noticeably higher ending balances. In contrast, many state tax benefits are modest, capped, or dependent on income and contribution levels. Therefore, if a national plan provides significantly lower fees and solid index options, the long-term effect can outweigh a one-time or limited annual deduction. The effect grows with time and account size. The most powerful driver of 529 outcomes remains tax-free compounding on a sensibly aggressive, low-cost portfolio, especially in the early years when the beneficiary is far from college. Now, let's put some numbers into a simple, illustrative comparison. This table is for illustration only and not advice. It compares a hypothetical annual state tax benefit with differences in expense ratios between an in-state plan and a top national plan. In scenario A, a $150 benefit may be outweighed by a 0.35% fee gap over a long horizon. In scenario B, the decision is tighter. In scenario C, with no tax benefit, the lower fee plan is often favored. These are simplified examples. Your own state's rules, income, and contribution amounts change the outcome. Next, let's pick the right building blocks inside a 529. Some 529 menus don't list an S&P 500 fund, but you can usually replicate broad exposure via a total U.S. stock market index. This includes large companies similar to the S&P 500 plus mid and small caps for more complete market coverage. If total market is missing, a large cap equity or blend index is often the next best option. Pure growth funds can be volatile and concentrated in specific sectors, making them less suitable as a core unless your risk tolerance is high and your time horizon is long. Global equity can further diversify your portfolio, but it generally works best as a complement to a strong domestic base. Now let's compare 2 popular core choices head-to-head. On the left, a total U.S. stock market index includes large, mid, and small caps, providing broader diversification and potentially capturing more long-term growth. On the right, an S&P 500-only approach focuses purely on large caps. While the S&P 500 has a strong long-term record, it is a narrower slice of the market and may miss periods when mid and small caps outperform. Both are typically inexpensive as index options, but if you want the broadest coverage in one fund, total market often wins as a core. With core building blocks in place, let's visualize an example allocation. This pie chart shows an illustrative early phase allocation with 90% in equities and 10% in bonds. It emphasizes maximizing equity exposure early to harness long-term, tax-free compounding. Of course, actual allocations should reflect risk tolerance, contribution consistency, and the time remaining until college. Now, as college approaches, many investors prefer an automated approach to de-risk over time. Let's look at target date funds. This timeline illustrates a typical target date fund glide path. High equity allocations early in life, gradually shifting into bonds as college approaches. Exact percentages vary by provider, but the concept is consistent. Automate the de-risking as the beneficiary ages so you maintain discipline and avoid emotional timing mistakes. With that foundation, let's describe how TDFs fit into a hands-off strategy. Target date funds simplify everything by packaging stocks and bonds into a single fund that automatically rebalances and de-risks as the beneficiary nears college. When investors stick with the plan, these funds can deliver strong results because they remove the temptation to time the market. Even so, it's essential to compare fees across providers, as low-cost TDFs typically produce better outcomes. Now, if you want a quick, practical way to pick a plan today, let's go step by step. Follow these practical steps to choose a plan in about 15 minutes. First, confirm your state's exact tax benefit and any contribution caps. Second, document your in-state plan's expense ratios and core index options. Third, compare those details with at least 2 top-rated national plans, focusing on costs and the availability of a total U.S. stock market index. Fourth, select your core building block, ideally a total market index, or, if unavailable, a large cap blend index. Fifth, if you prefer a hands-off approach, pick a target date fund aligned with the beneficiary's college start year. Sixth, consider adding international equity for diversification while maintaining a strong U.S. base. Seventh, revisit the analysis annually or whenever your contributions, fees, or the lineup changes. Now let's test your understanding with a quick quiz. Question 1. Which factor most reliably drives higher, long-term, 529 balances? Is it A, a modest state tax deduction, B, low fees plus broad equity exposure early on, C, chasing the hottest growth sectors, or D, frequent trading to time the market? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Low fees and broad early equity exposure are the primary drivers of long-term, tax-free compounding in a 529. While a state deduction helps, it is typically smaller in magnitude compared with the multi-year effect of lower expense ratios and disciplined asset allocation. Next, let's try a second question. Question 2. If your 529 doesn't list an S&P 500 index, what is usually the best next choice for broad U.S. exposure? Is it A, large cap equity or a blend index fund, B, a growth-only fund, C, a money market fund, or D, a single sector technology fund? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. If you can't get a total U.S. stock market index or an explicit S&P 500 index, a large cap equity or blend index typically provides broad, low-cost U.S. market exposure. Growth-only, money market, or single-sector funds are generally not ideal core holdings for long-term equity growth. With the quizzes complete, let's distill the key takeaways. The main points are straightforward. Do not assume your state's plan is best. Compare fees and fund menus. Prioritize low-cost index options, with total U.S. stock market as a strong core. Treat pure growth funds with caution unless your risk tolerance is high. Consider target date funds to automate de-risking and reduce behavioral errors. Finally, reevaluate annually as your contributions grow, fees evolve, and plan menus change. Before we conclude, let's include an important disclaimer. This content is educational and not financial, tax, or investment advice. Plan features, fees, and state tax rules change. Your personal circumstances, risk tolerance, and time horizon matter greatly. Always verify details with official plan documents and consult a qualified advisor or tax professional before making decisions. With that in mind, let's wrap up with a concise action summary. In summary, compare the value of your state's tax break with the long-term benefit of lower fees. Build your core with broad, low-cost U.S. equity exposure, ideally a total market index. Consider target date funds for a set-and-forget approach that maintains discipline. Diversify with global equity as a complement, not a replacement. Finally, review annually as fees, contributions, and options change. Now, to close us out, here's a quick thank you and a friendly call to action. Thank you for watching. If you found this helpful, please like, share, and subscribe. I'd love to hear what plan you chose, which funds you prefer, and how you weighed your state tax break against fees. Share your thoughts in the comments, and let's learn from each other.